Disclaimer.
Picture a loading bar. It's been sitting at 95% for 5 years. Not broken, not finished, just stuck. Every single time it inches toward completion, something slams it back. A margin hike, a wave of algorithmic selling, a flood of paper contracts that appear from nowhere. 5 years of that, 5 years of the bar trembling at 95%, then snapping back. That loading bar is silver. And this week, for the first time in modern memory, the tools misfired. The bar moved to 99%. If you've been watching silver at all, you already felt something different in late January 2026. Silver didn't just rise, it detonated. The metal punched through $100, blew past $110, and for one historic, breathless moment in the final days of January, silver touched $120 an ounce. A price level this market had never seen. Not in 1980. Not during the Hunt brothers saga. Never. And the financial world barely blinked because 8 days later, silver was trading near $70, a $50 collapse in less than 2 weeks. Most headlines called it volatility. A few called it a correction. But what actually happened was something far more revealing, and understanding it is the difference between getting caught flat-footed and being positioned for what's coming Monday. Here's what should grab your attention immediately. That collapse didn't happen because silver's fundamentals changed. It didn't happen because demand evaporated or because mines suddenly flooded the market with new supply. It happened because a specific set of tools were deployed simultaneously, the same tools that have managed silver's price for decades, and for the first time, those tools are showing you exactly how strained the system behind them has become. Let's talk about what those tools actually are, because most people have no idea this machinery exists. Think about the futures market for a moment. When you or I want to buy silver, we either go find the physical metal or we buy a contract representing silver, a promise of future delivery. The COMEX exchange in New York is where the vast majority of that paper silver trades, and it operates on margin, meaning you don't put up the full value of your contract, you put up a fraction, a deposit, and the exchange sets what that deposit size must be. When the exchange wants to slow a silver rally, one of the most effective tools available is simply raising that margin requirement. Suddenly, traders who are comfortable holding their positions can't afford to. They sell, price drops. It's legal, it's common, and it's been used on silver more aggressively than almost any other commodity in history. The second tool is algorithmic. High-frequency trading desks can execute tens of thousands of contracts in the time it takes you to read this sentence. When coordinated selling pressure hits the market at 2 a.m. on a Tuesday with no news catalyst, that's not organic. That's a deliberate intervention. This week, we saw a dump of approximately 47,000 contracts in a single overnight session, the equivalent of roughly 235 million ounces of silver changing hands on paper in hours, in a market where the total annual global mine supply is only about 800 million ounces. Let that sink in. In one night, paper silver equivalent to nearly 30% of annual global production was sold, not physical silver, paper. The third tool is inventory reclassification. COMEX vaults hold two categories of silver: eligible metal, which is stored there but not necessarily available for delivery, and registered metal, which is specifically set aside to back futures contracts. When regulators or exchange operators want to create the appearance of more deliverable supply, eligible silver can be reclassified as registered. It's accounting. It moves a number on a spreadsheet without moving a single ounce of physical metal. And this week, we saw a reclassification of 5.9 million ounces that has institutional analysts working overtime this weekend, trying to figure out who moved it and why. Now here's the part that changes everything. All three of those tools were deployed this week, simultaneously. Maximum suppression effort. And the net result from Monday's open to Friday's close was a price decline of approximately $5. $5. In prior cycles, this combination of interventions has crushed silver by 20%, 30%, sometimes 40% in a matter of days. The Hunt brothers' corner was broken with a single margin hike. The 2011 silver run from $49 was stopped cold by 5 consecutive margin increases over 8 days. The playbook has worked every time it's been run, until now. The same playbook, the same tools, maximum deployment, and the market shrugged off 90% of the effect. That's not volatility. That's a system showing you its limits. To understand why the tools are losing their grip, you have to understand what's changed underneath the market they're trying to manage. And the most important change is something called COMEX registered silver, the actual physical deliverable metal sitting in exchange vaults ready to back those paper contracts we talked about. In 2020, COMEX registered silver stood near 350 million ounces. That's a substantial buffer, enough deliverable metal to make anyone trying to force physical delivery think twice. By late 2021, it had dropped to 100 million ounces. By 2023, it was under 90 million. Today, as we enter March 2026, registered COMEX silver sits at approximately 81 million ounces. That's a 75% collapse in deliverable inventory over 5 years, while the paper market has continued operating as if nothing changed. But here's where the math becomes almost uncomfortable to look at directly. The March 2026 COMEX futures contract, just this one contract month, carries theoretical delivery obligations somewhere between 425 and 455 million ounces against 81 million ounces of registered silver. That's a ratio of more than 5 paper ounces for every 1 physical ounce available for delivery. And that 81 million ounce figure, it assumes every single ounce currently classified as registered actually stays put. That no large holder decides this weekend to demand their metal and drain the vault further. Have you ever wondered what happens when a promise outruns its backing? We've seen it before in our financial history. Mortgage-backed securities in 2008 were promises backed by assets that turned out to be worth a fraction of their paper value. The system held together until it couldn't, and then it didn't hold at all. The silver futures market is running a structurally similar imbalance, except in this case, the underlying asset is physical and finite. And the parties on the other side of those contracts include sovereign nations and institutional players who have recently decided they want the metal, not the paper. What makes this week's price action so significant, beyond the failed suppression attempt, is what it reveals about the people now on the buying side of this market. This isn't retail investors chasing momentum. When silver hit $120 in January, the buyers absorbing that price weren't day traders. They were entities willing to pay historic premiums for physical delivery in a month when COMEX delivery stress was already visible. And when the suppression tools hit, those same buyers didn't panic sell. They waited. The paper price dropped $50. The premium for physical silver, the actual cost to buy real metal and take possession, barely moved. That separation between paper price and physical reality is something that silver watchers have been waiting to see for years, and we're watching it happen in real time. Think about what that means practically. Somewhere out there, a buyer paid $115 for physical silver in late January. The paper market then told them their silver was worth $70. They didn't sell. Either they know something the paper market doesn't, or they believe what the paper market is showing them is increasingly irrelevant to what their physical metal will actually be worth when the delivery system finally reconciles with reality. The loading bar is at 99%. The tools that held it at 95% for 5 years deployed everything they had this week, and the bar barely moved back. What comes next isn't a question of whether the cage bends. It already bent. The question is, what happens when the 5 forces that are now converging all arrive at the same market on the same Monday morning, at the same moment that every institutional desk on the planet has spent the weekend doing the same math we just did? Because here's the thing about a loading bar stuck at 99%. It doesn't stay there forever. And when it finally finishes, when the reconciliation between paper promises and physical reality forces its way through, the people who understood what was actually happening aren't surprised. They were ready. Let's look at the evidence that this moment has been building for years, why China just changed everything, and what 5 specific forces are about to collide when the market opens Monday morning. There's a number that almost nobody is talking about, and it explains everything. 820 million ounces. That's the size of the hole. 5 consecutive years, 2021, 2022, 2023, 2024, and 2025, in which the world consumed more silver than it mined. Not by a little, by a cumulative 820 million ounces, according to the Silver Institute's annual supply-demand data. To put that in physical terms, imagine stacking silver bars from the floor of a warehouse to the ceiling, filling that warehouse completely, and then needing 4 more warehouses just like it. That's how much silver the world has consumed above and beyond what came out of the ground over the past 5 years. And unlike oil, which disperses into the atmosphere when burned, or grain, which is eaten and gone, silver is consumed industrially. It ends up in solar panels and semiconductors, in medical devices and electric vehicle components in quantities too small to recover economically. It doesn't come back. Now here's what makes this deficit uniquely dangerous compared to prior silver cycles. In 1979, when silver made its famous run from $6 to nearly $50, the deficit was measured in millions of ounces, a manageable gap that mine production could theoretically close within a year or two if prices incentivized new investment. The 820 million ounce deficit we're sitting on today represents roughly 1 full year of total global mine production, just to break even. And the industrial demand driving that deficit isn't slowing down. It's accelerating because the 2 fastest growing industries on the planet right now are solar energy and artificial intelligence infrastructure, and both of them run on silver. A single gigawatt of solar capacity requires approximately 1 million ounces of silver. The United States alone permitted over 50 gigawatts of new solar installations in 2024. Global AI data center build-out is driving demand for advanced semiconductors and high-frequency circuit boards where silver paste is irreplaceable. The Silver Institute project's industrial demand will set a new record in 2026 for the fourth consecutive year. So while the paper market was busy suppressing price, the physical world was quietly vacuuming silver out of every accessible vault on the planet. That's the structural backdrop. Now let's talk about what happened in January 2026 that fundamentally changed the game. Because three things occurred almost simultaneously, and the financial media covered each one in isolation without ever connecting the dots. The first was China. On January 14, 2026, the Chinese government formally designated silver as a strategic material. This wasn't symbolic. Strategic designation in China's regulatory framework triggers specific export control mechanisms, and within days, Chinese silver exports to Western markets slowed dramatically. To understand why this matters so completely, you need to know that China has been the world's second largest silver-producing nation and a significant re-exporter of refined silver to global markets. When Western exchanges ran short of registered inventory, one of the quiet balancing mechanisms was the ability to source silver through Asian trading channels. Ultimately, a lot of that metal had Chinese fingerprints on it. That pipeline just closed. What China's designation effectively did was fragment what had been a single, globally integrated silver market into three isolated islands: Asia, North America, and Europe. Each island now has to balance its own supply and demand without the ability to easily draw from the others. And of those three islands, North America, home to the COMEX, where our paper-to-physical imbalance lives, has the thinnest physical buffer. The 81 million ounces of registered COMEX silver now has to work harder because the emergency relief valve just got welded shut. Pop quiz: what happens to a pressure vessel when you seal the relief valve and keep adding pressure? The second institutional earthquake happened almost simultaneously. It came from a source that doesn't usually make headlines: Sprott Asset Management. If you're not familiar with Sprott, they run the Sprott Physical Silver Trust, a fund that doesn't trade paper silver or hold synthetic exposure. It buys actual physical bullion and stores it in a vault. In January 2026, Sprott announced it was doubling its capital raise target to $2 billion specifically to acquire physical silver. $2 billion pulled out of the paper system and locked in a vault. Why does this matter beyond the obvious? Because Sprott's action is a signal about where sophisticated institutional money now believes value actually resides. When a major financial institution raises $2 billion not to trade silver derivatives, but to own the physical metal outright, it's telling every other institutional investor on the planet something important. The paper silver market and the physical silver market are diverging, and the smart money wants to be on the physical side of that divergence. That's not speculation. That's a $2 billion institutional vote of no confidence in the paper system's ability to deliver. Think about the compounding effect here. Sprott is pulling physical silver out of the market at the same moment China is cutting off the supply channel that was quietly replenishing Western vaults. These two forces aren't just additive, they're multiplicative, because each one makes the other more powerful. The third development is happening right now in Shanghai, and it's the one that most American investors are completely unaware of. The Shanghai Futures Exchange, China's equivalent of our COMEX, has seen its silver inventories drop 75% year over year. 75%. That's not a seasonal fluctuation, that's a structural drain. But the more significant development is regulatory. Beginning March 1st, 2026, the SHFE implemented new hedging rules requiring every market participant to prove they have actual physical business ties to justify their silver positions. In plain English, if you're a speculative fund using the Shanghai Exchange to take paper silver positions that offset physical demand elsewhere in the market, you can no longer do that legally in China. This matters enormously for the global price discovery mechanism. For years, one of the ways large traders managed silver's price globally was through a sophisticated arbitrage between paper positions on Western exchanges and offsetting positions on Eastern exchanges. That arbitrage kept silver from making moves that either market alone couldn't absorb. The SHFE's new rules just dismantled the eastern leg of that structure. The coordination that kept silver contained is losing its infrastructure on multiple continents simultaneously. Here's what should genuinely concern anyone paying attention. None of these three developments, China's strategic designation, Sprott's $2 billion physical pull, and the SHFE's hedging rule change, was a response to silver's price spike. They were all in motion before silver hit $120. The price spike was a symptom of these forces, not the cause, which means crushing the price back to $70 didn't address the underlying dynamics at all. The fundamentals that drove silver to $120 are still present. In several cases, they're more acute now than they were in January because the suppression effort itself consumed additional physical silver through delivery demands from traders who used the paper crash as an opportunity to take metal off the exchange at a discount. Let me give you a concrete scenario that illustrates what this looks like from inside a major institution right now. Imagine you run a silver desk at a global bank. Your job is to manage silver exposure. buying and selling contracts, facilitating client trades, maintaining orderly markets. On a normal week, if you need to source physical silver, you have several channels. COMEX registered inventory, the London OTC market, and historically, some ability to source through Asian channels. This week, you tried to use all three channels simultaneously and found that each one had less capacity than the last time you checked. COMEX registered is at a 5-year low. London OTC premiums are elevated because European institutions are scrambling for the same physical metal. And the Asian channel, China just changed the rules. Now you have clients, pension funds, sovereign wealth funds, industrial manufacturers who actually need silver to make things, all asking you the same question. Where is the metal, and how much will it actually cost us to get it? The paper price says $75, but the all-in cost of sourcing physical silver and taking delivery right now is running considerably higher than that, and the gap between those two numbers is what traders call the physical premium. When that premium widens persistently, it's the market telling you that the paper price has become a fiction. Not immediately, not all at once, but gradually and then suddenly. Federal Reserve data on commodity market stress indicators, the Bank for International Settlements quarterly derivatives reports, and multiple independent analyses from commodity research firms all point to the same structural observation. Silver's paper to physical ratio has reached levels that have historically preceded significant price dislocations. The BIS data specifically flags markets where notional derivatives exposure exceeds 400% of deliverable physical supply. As carrying elevated reconciliation risk, silver is currently running above 500%. We are not watching a commodity rally. We are watching a 5-year supply deficit, a physical drain that has eliminated 75% of exchange-registered inventory, a geopolitical pivot by the world's second-largest economy, and a $2 billion institutional signal, all converging on a market whose paper infrastructure was built for a world that no longer exists. The cage didn't just bend this week. The cage was always an illusion maintained by the assumption that nobody would actually ask for their silver all at once. And now, for the first time, multiple large players are asking simultaneously, not because they read the same newsletter, but because they each independently did the same math and arrived at the same conclusion. Now let's talk about the 5 specific forces landing on Monday morning, the price levels the math actually implies, and why March 18th may be the last date that matters before this resolves itself one way or the other. If you were investing in 1979, you remember the feeling. Not the numbers, the feeling. The sense that something enormous was shifting beneath the surface of markets that looked, on most days, perfectly ordinary. Grocery stores were open. Banks were processing transactions. The stock market was ticking along. And quietly, almost invisibly, silver was doing something that nobody in the mainstream financial press was taking seriously, until it went from $6 an ounce to $50 in 14 months, and made a lot of very calm, very patient people extraordinarily wealthy while everyone else scrambled to understand what had just happened. What broke in 1979 wasn't just a price level. What broke was the assumption that the tools managing silver's price were permanent. They weren't. They were load-bearing structures that held until the weight against them exceeded their design limit, and then they didn't hold at all. The deficit driving that move was measured in the tens of millions of ounces. The institutional infrastructure suppressing price was smaller, slower, and less sophisticated than what exists today. And silver still multiplied 8 times in 14 months. Today's deficit is 820 million ounces. The suppression infrastructure is more sophisticated, and it just failed to contain a rally using every tool simultaneously. The structural parallel to 1979 isn't poetic, it's mathematical. And the math says the conditions today are not similar to 1979. They are more extreme in almost every measurable dimension. So let's walk through exactly what's arriving Monday morning, force by force, because each one matters independently. And together, they create a convergence that the market's paper infrastructure was genuinely not designed to handle. Force 1 landed Friday morning at 8:30 a.m. Eastern, the February jobs report. Here's what's elegant about this particular data point for silver right now. It doesn't matter whether the number came in strong or weak. A weak jobs number accelerates the probability of a Federal Reserve rate cut before the Fed's March 18th blackout period begins, which instantly makes hard assets like silver more attractive relative to yield-bearing alternatives and pushes institutional capital toward commodities. A strong jobs number confirms that industrial demand across the American economy remains robust, which means silver's industrial consumption, already running at record levels, continues accelerating. Either scenario is constructive for silver over different time horizons, and institutional algorithms running Friday afternoon were simultaneously processing both interpretations. That capital, positioned on both sides of the jobs number trade, now needs to be redeployed when the market opens Monday, and a significant portion of it is pointing at physical silver as the asset that wins under both outcomes. Force 2 is the one that most retail investors don't even know happened. On Thursday, the CME Group, the operator of the COMEX exchange, reduced silver margin requirements. Think about what that actually means in practice. When margins are high, large amounts of institutional capital are locked up as collateral, essentially frozen, unavailable for new positions. When margins drop, that capital is freed, not slowly, not gradually, all at once. The capital that was sitting as margin collateral on Thursday evening is now fully liquid and available to deploy the moment Monday's session opens. We're talking about billions of dollars in institutional capital that physically could not enter new silver positions on Friday that now can. Monday morning's open will be the first moment that freed capital has access to the market. And given everything else happening simultaneously, the question isn't whether some of it flows into silver. The question is how much and how fast. Force 3 is the 5.9 million ounce reclassification we mentioned earlier, the unexplained movement of silver between inventory categories that showed up in COMEX data this week. Every major institutional research desk has spent the weekend investigating this. The question they're all trying to answer is the same: who moved it and why? If the investigation turns up sovereign fingerprints, evidence that a nation state or central bank was behind the reclassification, the implication is immediate and severe. It means a large, well-resourced actor with privileged market access is positioning for a delivery demand on the remaining 81 million registered ounces. That conclusion landing in institutional research reports. Monday morning creates a first-mover problem. Every desk that reads it wants to be ahead of the delivery rush, not caught in it. And first-mover dynamics in a market with a 5-to-1 paper-to-physical imbalance can move very, very quickly. Force 4 flows directly from China's data blackout. When the SHFE went quiet on silver inventory reporting, combined with the new hedging rules that took effect March 1st, institutional research desks found themselves flying blind on Eastern supply data for the first time in years. The reports being finalized over the weekend, landing on trading desks Monday at 7 a.m., are uniformly recommending the same hedge: increase physical silver allocation as a direct response to the information vacuum. When you can't see what's happening in the world's second largest silver market, the rational response is to own the metal outright, rather than relying on paper exposure that depends on a functioning arbitrage between Eastern and Western markets. Force 4 is essentially the market's risk management apparatus responding to the collapse of the information infrastructure that made paper silver feel safe to hold. Force 5 is the one that almost nobody is connecting to silver yet, and it may be the most consequential of all. Kevin Warsh, a former Federal Reserve governor, known as one of the most hawkish voices in American monetary policy circles, has been nominated as the next Fed chair. If confirmed, Warsh represents a fundamental pivot in the Fed's policy trajectory. Markets currently have a rate cut path priced in. Warsh's leadership would likely compress or eliminate that path, creating what traders are calling a May 2026 policy cliff, a moment when current market assumptions about the Fed's direction collide with a new reality. Here's why this matters specifically for silver, and why it matters right now. Sophisticated institutional investors have a narrow window between today and the point when Warsh's policy intentions become clear to position in hard assets before the uncertainty gets fully priced in. That window is closing. The investors who understand this are making silver allocation decisions this weekend, and those decisions execute Monday morning. Force 5 isn't about silver's fundamentals at all. It's about the monetary policy environment that either supports or undermines every paper asset in our financial system. And silver is one of the clearest beneficiaries of that uncertainty, regardless of which direction Warsh ultimately takes us. Now let's talk about price, because this is where the math becomes something you can actually use. The gold to silver ratio is one of the oldest and most reliable relative value measures in financial markets. It simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, when silver is fairly valued relative to gold, that ratio runs somewhere between 40 and 65. In late January 2026, when silver hit $120, the ratio compressed to 45.1, the tightest it had been since 2011. Today, with gold trading above $500 to $400 an ounce, a return to that same 45.1 ratio mathematically implies silver above $120. Not as a prediction, not as a forecast, as arithmetic. If you believe gold's price reflects reality, and the central banks of the world are buying gold at record rates, so presumably they do, then silver at current prices is not a speculative bet. It's a mathematical discount to a ratio the market already established last month. What if you want institutional validation rather than just the ratio math? JP Morgan's commodity research team projects silver averaging $81 per ounce for full year 2026. Citi's forecast, published before the new year, targets $100 to $110 by mid-2026. Both of those forecasts were constructed before China's export restrictions fully materialized, before the March COMEX delivery stress became visible, and before the SHFE's new hedging rules created the supply fragmentation we're now living inside. The analysts who built those models are already revising them. The institutional price targets for silver in 2026 are stale, and they're stale to the upside, meaning reality is running ahead of the models faster than the models can catch up. Which brings us to March 18th. That's the date of the Federal Reserve's next policy meeting. The first since silver's historic spike and crash, the first under the shadow of the Warsh nomination, and the first at which the Fed's forward guidance will either accelerate or constrain everything we've been discussing. If the Fed signals a clear rate cut path, validating the market's current expectations, hard assets broadly and silver specifically lose one of the few remaining arguments for caution. Capital that has been sitting on the sidelines waiting for monetary clarity gets a green light, and the five forces we've already described are now amplified by a sixth: Fed-validated momentum. If the Fed instead signals a hawkish reset, a Warsh-influenced tightening bias, the uncertainty itself becomes the catalyst. Silver has historically performed well during periods of genuine monetary uncertainty because it sits at the intersection of two demand drivers that pull in different directions. It benefits from low rates as a store of value, and it benefits from economic strength as an industrial metal. Either Fed outcome resolves the uncertainty that is currently the only thing keeping significant institutional capital on the sidelines. March 18th is the last wall of the cage. Here's what we need to sit with as Americans who have watched our purchasing power erode, our savings work harder for less return, and our financial system navigate one stress point after another over the past decade. We are not watching a silver story. We are watching a story about what happens when paper promises outrun physical reality. A story our financial system has told before, in mortgages, in bank balance sheets, and sovereign debt. And the lesson is always the same. The reconciliation comes. It comes later than anyone expects, and faster than anyone is ready for. The people who understood what was happening in 1979 didn't need to predict the exact timing. They needed to understand the structure, the deficit, the suppression, the mathematical impossibility of the paper promise outlasting the physical reality, and position themselves accordingly before the reconciliation forced everyone else's hand. The same understanding is available to us right now, with cleaner data, better tools, and a structural imbalance that is larger and more visible than anything that existed in 1979. In 1979, the last time suppression tools failed this publicly, silver multiplied 8 times in 14 months. The deficit then was measured in millions of ounces. Today, it's 820 million ounces, and climbing. 5 forces are landing on the same Monday morning in a market running a 5-to-1 paper-to-physical imbalance, with its eastern supply valve sealed shut, its institutional exit routes narrowing, and its final regulatory constraint, the Fed's March 18th guidance, 2 weeks away from resolution. The cage isn't just bending. The math says it was never strong enough to hold. The loading bar is at 99%, and this time, nothing is hitting the cancel button.